Hello, everybody. Mike Wisniewski with Materials Exchange here. I am running the show solo today. Greg Kuda is on the road, but we'll give it just a minute here to let everyone get in. Today will be a great day to ask questions. I should be able to answer questions much more easily today. What I'm doing here is I'm pulling up LinkedIn on my phone to see how many people we have on the LinkedIn page as well. There we go. All right, cool. So, I have that set. And let's kick it off here. So, August 30th, where has the summer gone? One more day in August, August 31st, which on September 1st, very important to note, the September lumber futures contract will have no limits. So, the risk goes up a little bit there. You definitely want to be cognizant of that. And that includes the new contract as well. So the mini, I guess we'll call that the mini lumber, will also not have any limits. Move to the next page. And this, of course, was put together by Greg Kuda with Westline Capital Strategies and StoneX. So let's take we'll start out at the big picture idea. The one thing that I'm seeing in this big picture is it appears as though trends have stopped. You can see the trend in crude heading down right here. And it appears, I'm not saying that it's reversed. I'm just saying it appears as though we've kind of stopped going down in crude. You can look at the 10-year notes from the mid-June up till basically the beginning of August. Interest rates were going down, but that has definitely stopped, and the interest rates are leaking back up. Lumber, in my opinion, is kind of sideways-ish. The equity market, the NASDAQ and the Dow Jones have definitely stopped going back up. The big news on Friday coming out of the Jackson Hole summit, where Chairman Powell basically reiterated the Fed is not afraid to continue to fight inflation with all their power, which, of course, their power lies in the raising of the short-term overnight interest rates. So this is a big story, and I don't know that it's been covered enough, mostly because here in the United States, we don't feel it, but the US dollar index is at a 22-year high. So let's think about 22 years ago, it was the year 2000. This is, before 9/11. We were coming out of I guess that was kind of the dot-com bust. But what this is telling us is that we've got big dollars, like our money buys a lot. That should be somewhat deflationary to me. But the thing for the lumber industry we have to take into consideration is that it makes the United States a very attractive place to sell your products. So for the Europeans, every time the dollar gets stronger, it just improves their return. Then we can also look as the dollar gets stronger, crude oil gets cheaper. So, if you're sitting in Saudi Arabia, for instance, and you're selling your crude, if every time the dollar goes up a little higher, when you convert the dollars that you sell your crude back into your local currency, you just get more. Now the other things here, I'm looking at copper. It makes copper a little cheaper. It makes gold, I guess, a little bit cheaper. I'm not so sure about the gold scenario there, but wheat Wheat's kind of drifting up a little bit. Not so sure about what wheat means there. All right, let's take a look at the winners and losers here. Palladium, copper, and wheat all up at the top, but the one that sticks out for me is the VIX. That's the measure of the price of options on the S&P 500 contract. So what they're saying is they're buying options. The interest is in it. When you buy an option, it's like buying an insurance policy. It's a protectionism type move that you are worried about an adverse move to your position. Generally, what they're buying are put options. You can see nothing else really jumps out at me here. And then when we look at the losers, what's jumping out at me here is the Russian ruble. Wow, Russian ruble is getting kind of whacked. And one of the things that personally makes me happy is gasoline prices are falling. And I think that it's a direct reflection of high prices had people change their behavior. Then, we're seeing copper fall, and copper is a bellwether commodity for many products, including construction, but a lot of durable goods are using, use copper. Lumber is up here. Once again, nothing kind of remarkable. Natural gas has actually fallen, which is pretty interesting given the geopolitical environment. I'd like to see natty gas come down a little more. I know Europe in Germany in particular, is definitely going to have an interesting winter with the price of natural gas. I'm glad Greg put this in. This is the volatility chart, and it's the CME lumber implied volatility. Implied volatility is derived from the price of options, the price that options are trading at. There's a great formula, the Black-Scholes formula, and a few other different mathematical formulas that calculate how much an option should price based on a volatility. And then you can turn around and go backwards down the street and you say, okay, if an option is trading at a particular price, what is that implying for a volatility? We all remember back in February and March when the market was extremely volatile, rising very quickly and then falling just as sharply. Those were volatile times, and the option markets priced it in accordingly. So the gold line here is the implied volatility. The blue line is the 5-year average volatility, and there definitely is some seasonality, and it appears we're very near peak seasonality for implied volatility, and it drifts off going into the end of the year. So option traders generally get this pretty right. So what it's telling us is that the market should be kind of calm. Historically speaking, the market calms down between now and the end of the year from a volatility, which is the swing, how wildly the market is swinging. All right, let's see what's next here. This chart really surprised me, and I guess I just hadn't thought about it or looked at it before, but it shows the total number of exchange for physical per contract period, going back to 2017. Unfortunately, September's cut off here, but what I was looking at is the September contract. So in 2018, it's right here, did 326, but then in 2019, only 27 were done. That's one of the lowest points on this chart. 2020 we did up at 233, but then again in last year, 2021, we only did 55. So I'm not sure what to read into this, but it certainly seems that the summer months, your July right here, July, Sep, no, there aren't a lot of, I guess there's probably not a lot of industry or inventory building going on. So people are not using the futures markets as a procurement method. And you can see so far to date, only 8 have been done on this contract. Obviously, we're a good 12 business days away from the contract expiring. So, but it was interesting. Why in July of 21 we did 342 and then only 55 in September. And as we get to the next couple of statistics where we're talking about who's in the market right now, it'll probably make more sense why this number is pretty low so far. So let's take a look at a seasonal. What does this tell us? The black solid line is the 5-year average. Theoretically, we should be kind of trending higher. Well, wait a minute. No, I guess seasonal, we drop back down. So yeah, the seasonals are, going against us. The way this chart works is you roll off this edge and back onto that. It's kind of like if the screen was just spinning in a circle in front of you, like the background in an old TV or an old movie. So yeah, the seasonals don't fare too well for looking forward right now. The 3-year average took a pretty big drop, and the 5-year average takes a pretty good drop. So I'd say the seasonals are looking weak. Once again, this is another chart that just kind of surprised me, brought me back to reality. If we closed September today, second highest close on record. These prices are fantastic for lumber producers, absent of knowing what their input log costs are. But the amount of money that they are getting for the product that they are selling based off of futures prices, second highest on record. Something important, in my opinion, to put in the back of your mind when you're considering potential, how far the market could move lower. And then you can't discount this 920 out here. I like how what the market could do moving higher. This is, my favorite chart, weekly continuation. I think it just tells you a lot about the overall health of the market. And, I'd love to be able to cover up. I don't know how I could do that, but, if you take a look at where we were and where we are, we seem to be back to these low points. Well, not seem, we are back to these low points. And the question in my mind is, are we going to bounce at these levels, or is something going to change? Are we going to blow through them? Here's your SEP daily chart from a week ago. And, if I'm looking at this chart a week ago, I was probably pretty bearish. It kind of rolled over. I was looking for it to take out the lows. And he flipped over to the SEP Nove chart. And this was the SEP Nove chart on the 23rd. Something that Greg and I had talked quite a bit about, which was the structure of the market, who's long, who's short. And it's playing out exactly as we had kind of predicted. In the fast money, the fund money is short, and they need to buy back their contracts, and they want to roll it to September. And that's what they're doing. They're buying September and selling November. For perspective, what can happen on a SEP Nove spread? The same thing happened in July. And then we hit a point where once you enter into the expiration month and liquidity becomes much more, there's much less liquidity, the moves can happen much more quickly and more pronounced. So, this is right at the beginning of July. The July SEP spread took a dramatic drop and then finished kind of right back where that drop had started. So, word to the wise, or caution, words of caution, I should say. When the funds are done doing what they need to do, the market can make a dramatic move. All right, basis. This is an important chart to look at. We talk about it a lot. It's the difference between, are we in a market where you forward price, meaning it is cheaper to buy in the futures, or is this a market where you buy in the cash market and hedge? Is it a basis? Well, that's called a basis trade, of course. Is it a buy and hold and put a hedge on? Anything below this gray line represents opportunities to buy cash and sell futures. So you look back in this time a year ago was really an excellent opportunity to be buying cash wood and selling futures. And then the market did reverse, and you had the opportunity to sell. If you bought and held, bought that wood and held it, you could sell your cash wood much higher than where your futures price was. We dipped back down. We had that quick little opportunity, pretty short-lived. Not really sure if that actually was there. Where we're at today, we're kind of right in the middle. Not much opportunity to get long cash, sell futures. Not much real opportunity to price forward. Here's the forward curve on the legacy, the big contracts, and nothing too remarkable. It's really pricing in mostly some carry trade. There's a little premium for the January contract over November. I mean, what is that? $30 a thousand. But this is $12 I'm sorry, $15 a thousand here from January to March. That's basically the cost of carry. And then I would say this doesn't even figure in the cost of carry from March to May. Cost of carry, of course, being the cost of your money and the storage charges and the opportunity lost. The new futures contract, same thing. It's a pretty unremarkable, normal cost of carry market. All right, we're gonna go back to the basis. A week ago, the basis was at 75 over. A year ago, it was 102 over. As of this week, it's 34. So how did we get there? It was pretty much a little bit of rally in the futures and then a significant pullback in the cash market. The NOV contract, it's still it's a forward price contract there. If you wanted to buy wood for November that you needed in November, it is a much better buy using the futures market than it is buying in the cash market. That's basically what this is saying. All right, so now we're going to take a quick look into the structure of the market. And this was from Monday, August 22nd, a little over a week ago. Open interest was 2,300, basically evenly split between the September and the November contract. Then you fast forward to today. The open interest is 2,368. We've picked up a small amount of open interest. What was it about? 2-3%. But you can see that, as expected, the open interest has fallen in the September contract, and it's moving over into that November contract. So November is the big dog on the block right now. Definitely the highest volume being traded, and it has the most open interest. Total open interest, while this chart is a little difficult to look at right here, this purple line is 2022. Historically, we're at some low open interest, but this is the trend that we've had for the last few years. 2019, we're at the same point, and 2021, for all intents and purposes, we are at the same point. I am very optimistic that the new futures contract, once it gets up and running and we get some new participants in the market, we could see this open interest number jump. And not just because there's 4 to 1, but I could see, if instead of being at 2,300, we should be at about a 10,000, over 10,000 in open interest. Now, this is the most important statistic that we can talk about and we've been talking about it for a while. As of August 23rd, which was a week ago today, from the previous 5 trading days, the open interest in managed money, which these are the funds, jumped 268 contracts. And it is 100%. They are totally short. These are financial trader people who are saying lumber, we believe lumber's going down across the board, 100%. They think the price of lumber is going down. Now, they may think this because it's part of the thesis on their fund being all commodities are going to get pressured. But the reality is 55%, over half of the open contracts right now are held by non-industry financial type participants. Then we flip back over to the hedger, the producer merchants. Short interest, people who would say, I am concerned that the prices are going to go lower and adversely affect my business because I may be long lumber right now, I may own lumber, or I'm a producer and I will be making lumber. 237. Very low number. This is the fear gauge. The fear of lower prices from the industry is extremely low. In fact, the opportunity for higher prices, the fear of higher prices is high over here. It's 1,000. It's 4 to 1. And then this dichotomy is just remarkable. You look at the managed money. The fear of higher prices is nil. The opportunity for lower prices, 100%. Then, we look at some of the other reportables. Nothing remarkable here. I think in this other reportables, probably some industry people leaning long, but non-reportable, that's flat. But what we do know is this managed money position will take that bet off the table at some time. And they take it off when they feel their opportunity is gone or they get forced out. And the new mini lumber futures, I highly encourage people to take a look and look at trading that. The spread here, which I like to look at the SEP NOV spread. It today again it traded 48. I think let's see, the last trade was 48. It's 17.10 bid at 48.20 offered right now, the same as what's on here. You compare that to the bigs, where it's right at $30. So I guess it's falling solidly in between here. The conversion spread, this one is rather fascinating to me, that this 114 is no longer bid up here. This is where you would convert your either mini lumber futures into a big lumber futures or vice versa. 114 seems really high to me for an expiration or a delivery. I would think that there is a product out there that you could make delivery on into the futures that is less than $114 over the price of Western spruce in British Columbia. But my guess is this is just a function of lack of liquidity in that contract. And then, there's a $115 offer out there. I'll be very interested to see where this conversion spread really ends up. And, if you want to put an opinion in the chat, I'd be fascinated to hear what you think. Where would you buy the minis compared to and sell the bigs and vice versa? It seems as though there's got to be some producer in Eastern Canada that can deliver into this contract at a much more favorable rate than this $114, which of course would drive that down. All right, rail. What are we looking at here? Originated rail traffic. 2021, we saw a major dive at the end of the year. That was some transportation issues. That's what's going on over here. But we're kind of right in the middle of the range of where we've been historically. It's not fantastic. If we saw rail traffic up here, it would be a lot better. But nothing too dramatic. I guess it's off a little bit, but I'd like to see it better. What's this? Just talking about that new contract, and okay, that wraps that up. Couple off the cuff comments that I'm going to have before I jump into what I want to do next. This has been the quietest hurricane season up till now for the Atlantic Basin in like 25 years. So yeah, no one's talking about hurricanes. I find that kind of interesting. I read yesterday, Sodra over in Finland has curtailed production. They, I think what we're starting to see is the known news out there. That what's known. Housing starts have gone down. Builder sentiment is lower. The overall belief that the consumption of lumber will be lower moving forward is a known fact and it's in the market. Prices have moved down. You're starting to see producers like Sodra, for instance, curtail production. I saw Roseburg also indefinitely curtailed production. It's never the first one that makes the move, and it's hard to know which announcement it actually is going to be that causes a dramatic change in the market. What I'm looking at here is we are at a point in the market that there is discussions in the boardroom of producers saying, wow, do we really want to run right now? Does it make sense for us to be going at full capacity? Obviously, when lumber prices are at $1,000 a thousand, that's not a discussion. The discussion is how can we produce more? So every move lower here is going to have a stronger conversation like that in the boardroom. So I guess the first shot over the bow has been seen. So that's something I'm keeping my eye on. Let's we're going to move into, before I do that, I do want to look at one. Let's look at some, I guess we can look at it when we look at a chart. Let's do that. What I want to show you guys today, this is BarChart.com. BarChart.com is based here in Chicago, and this is a free version of charting software that you can use. It's super powerful. It's really good stuff. Right here, you can see there's a tutorial. You can watch videos on how to use this. I'm going to just show you a few things. I think anyone who's in the lumber market should be looking at these charts and should be using, all these tools available. What I want to talk about today are stochastics and RSI, relative strength index. These are measures of momentum, measures of how the prices are moving, how fast they are moving in directions. They're good leading indicators of changes in the trend. Once again, you can't hang your hat on one, but let me flip back and we're just going to look at the definition of what a stochastic is. Where did you go? No, that's not it. It's my PDF. Sorry. Here we go. The stochastic momentum oscillator is used to compare where a security price, in this case, it's a futures price, closed relative to its price range over a given period of time. So if you take the range that the market moved in on a day as kind of the goal, the end lines, and then where did it close? If it closed near the high, that is an indicator that we would be moving higher. That's a momentum moving higher. If it closes near the low, it's the opposite of that. Now there are two type of stochastics: fast and slow, and it's the difference between them is summed up in one word: it's sensitivity. The fast is much more sensitive to these movements. The slow kind of numbs it down a little bit. The relative strength index, once again, is another momentum indicator, and it measures the speed and magnitude of a security's recent price changes to evaluate overvalued and undervalued. Sometimes I believe these two terms, overvalued and undervalued, are used just a little too loosely and too often, because while they can describe what a person's opinion is on a market, it doesn't necessarily mean that it's going to cause a change in the trend. So this really is all about figuring out overvalued, undervalued, and momentum of moves. All right, so that's the rough and dirty definitions. Now let's go back to BarChart.com. I'm actually just going to get rid of these, and I'm going to show you guys and gals how to pull up a momentum analysis on BarChart.com. Make this slightly smaller. So what you do is you come up to the top here, and I have this first thing right in the middle is where you can choose the chart that you want to look at. What we're looking at now, this is November lumber futures, and it's the daily nearby, meaning it takes whatever the most widely traded is and makes a smooth chart out of that. So here's the daily nearby. Right now, it is using the November futures. I'm going to come up here and I go on this button here called Study. You click that, and it has all these different studies you can look at. But the first one I will pull up is the relative strength indicator, relative strength index. I click that. The period, you can change this, but most people look at a 14-day period. So what this does is it takes the previous 14 days. It looks back in time on 14 days. And here they're saying oversold is when that calculation is at a 30. It goes from 0 to 100. Overbought is when it's at a 70. All right, let's just add this on. So here's the 30 line, and you can see that it has filled in. These are conditions where they say this market is oversold. Then you go above 70, which is right here. And not surprising, we've been in a pretty bear market. It has not gotten into the overbought stage. Now, once again, it looks right here. Oh, wow, this indicator was super good at predicting the turn, which, yeah, it wasn't bad, right? But I'd like to show you back here. If you would have bought into that, oh, this is the only thing to look at, when it made its bump out of this move, you would have been buying lumber futures at 800 when it ended up going down to 500. So, like a 40% loss. So markets can stay in the oversold and overbought range for extended periods of time. This is a very powerful indicator when it's used in conjunction with other technical analysis. So that's one heads up. But I like it. I'm a big fan of RSI. It's a quick way to look at the market and say, what have we been doing? Then the next one I want to throw up, let's just get rid of it. Well, I'll put the alongside. We're going to go to Stochastics, STOC, Stochastics Momentum Index. And this one's looking at 10 period back with oversold, overbought at negative 40 and 40. I'm adding this in. We'll scroll down. And you can see it basically mimics the RSI. It just has a little bit different calculation. This one I'm not as big a fan of. I personally like to put on the fast and slow stochastics. So fast, we'll add that in because it's looking back 14 days. And then we're going to look at the slow. So now let's take a look. And the first thing you're going to notice the difference between the fast and the slow. The fast is a little choppier. The slow has things smoothed out a bit. But you know, it's once again, this is an indicator that looks back, and it can tell you when trends have changed. And it did a really good job, like, you know, right here, saying, okay, we are done with being oversold. Maybe this market's made a bottom. And in fact, what you can use, one way to really use these indicators is they'll keep you in a trade. So if you really wanted to buy it down here and you bought it and the market moved and now you hit like this section where we kind of went sideways to lower, neither one of these indicators gave you any big heartburn about exiting your position. And in fact, if you would have held on, you know, if you got long, of course, you had a nice gain. So I guess that's where we'll wrap up today. Highly encourage using this BarChart.com. Number one, it's free. Great data. It's easy to use. If you have any questions, you can give me a call, and you can also use the tutorials. So with that, I'm going to wrap it up. Thanks everyone for tuning in. As always, we appreciate your support, and whatever we can do. If there's anything else you want to see, let us know. Greg, I know we'll be back next week, and then the following week we'll be at the BCMC show, and we'll be reporting from there. So take care, everyone. Be safe. Have a great holiday weekend. Thank you.